Hello everyone, and welcome to today's lecture in our derivatives course. We've already introduced futures, forwards, and options. Today we'll take a closer look at one of the simplest but most powerful option strategies, buying a call option. By the end of this lecture, you'll understand what it means to buy a call option, its features, why investors do it, and how it works in practice. Buying a call option gives the investor the right, but not the obligation, to buy an underlying asset at a predetermined price, known as the strike price, on or before a set expiration date. The buyer pays a premium for this right. If the asset's price rises above the strike, the call increases in value. If it stays below the strike, the option may expire worthless. The key point is that the buyer's maximum loss is limited to the premium paid. Let's go over the main features of buying a call option. First, the right to buy. The buyer has control, but never the obligation, to purchase the asset. Second, the premium. This is the price paid to acquire the option upfront. Third, leverage. Calls allow investors to control a large notional value with relatively small capital. Fourth, limited risk. The worst-case scenario is losing the premium. Fifth, unlimited upside. If the underlying keeps rising, the profit potential is essentially unbounded. Here's an example. Suppose stock XYZ is trading at $50. An investor expects the price to rise over the next 3 months. The investor buys a 3-month call option with a strike price of $55, paying $2 per share as a premium. Since each option contract covers 100 shares, the total premium is $200. Scenario 1. If the stock rises to $65, the option payoff is $10 per share. After subtracting the $2 premium, the net profit is $8 per share, or $800 total. That's a fourfold return on the initial $200 investment. Scenario 2. If the stock stays below $55, the option expires worthless. The investor loses the $200 premium, but nothing more. This highlights the defined risk and leverage potential of call options. So why would an investor buy a call option? For speculation, if you expect the stock to rise, calls provide a way to profit with limited risk and smaller upfront capital. For leverage, you can gain exposure to stock price movements without buying the shares outright. For defined risk, unlike buying the stock, where losses can be large, with calls, your maximum loss is capped at the premium. For portfolio strategy, calls can be used to enhance returns, complement long stock positions, or test a bullish view without heavy commitment. In summary, buying a call option is a bullish strategy. It gives investors the chance to profit from rising prices while limiting risk to the premium paid. This combination of limited downside and unlimited upside makes calls an attractive tool for speculation and portfolio management. But remember, options are not free money. They require correct timing and direction. This concludes our discussion about buying a call option. See you at the next lecture.